Welcome to the first broadcast of the Friday Rewind from Financial Advisor Television. My name is Jay Coulter, and like everything we do at Financial Advisor TV here during the soft launch, this is an experiment. To get you up to speed as far as our soft launch has gone so far, we started in November. We wanted to prove that we could do 3 broadcasts a day during the work week and bring you thought leaders from around the investment, thought leadership, financial planning world. And we found out that not only was it easy to execute on it, there is a market for people who are looking for premium advisor content. Here in November, we've been playing with a new website. Please check out financialadvisor.tv. Love to have you over there in the community as we're getting started. And then we played around with broadcast schedules. We've had some sponsors sign up. We've had lots of folks interested in syndication and lots of teams that have signed up to be syndicated. If you're interested in having your content syndicated on Financial Advisor TV, shoot me a message here on social media or head on over to fatelevision.com. That is fatelevision.com. Here's the concept behind Friday Rewind. So between the Resilient Advisor Show, ETF stories, investment spotlight, plus all of the great content that we produce for our clients, there's a market to go out and find clips of the best ideas in the marketplace. So I'm going to run through some of the best ideas that we've seen recently broadcast on Financial Advisor Television. The first comes from the Kevin Simpson Show. He had the opportunity to have Dan Nathan and Guy Adami. You probably recognize them from CNBC on their show. And here's some thoughts that they had. As we're recording this, Bitcoin is back up over 50,000. How should advisors who are skeptical of the space start to look at this as an asset class, as a potential inflation hedge?
Yeah, that's a great question. And I mean, just so you know, I started out as kind of a skeptic, and then I've gone kind of back and forth because, really, I have not gone deep down the rabbit hole of, of cryptography. I'm certainly not, one of these, brilliant economic thinkers by any means. I'm just a dumb trader of stocks and options and that sort of thing. But I do find it intellectually very interesting. And what I find most interesting about the space is that some of the smartest people that I know in finance, in tech, are all in on this. And I've just been doing this for 25 years now. And I started in the late 90s. And I remember the skepticism around e-commerce, around the internet, around a lot of related sort of the internet's ability to transform industries. And when I look around and I see some of the biggest advocates for crypto in general, not just the currencies. And I think Bitcoin has a bit of a branding problem. I don't think it should be called a cryptocurrency. I don't know about you guys. I don't know anybody who owns Bitcoin who uses it as a currency. I think they use it as a store of value, a better store of value than maybe gold. And a lot of advisors who are listening to this have probably allocated maybe low single digits percentage of portfolios to gold for a very long time. And I just don't know why anybody would continue to do that unless you thought that Bitcoin or related cryptos that are viewed as a store of value are a total scam. And I just don't think that you can have a 2 trillion plus asset class that's been around this long. That's a scam. And then the sort of money that's being allocated to it and the sort of brain power that's focused on it and the sort of protocols that are being built in and around it.
Could not agree with his assessment. I tell you what I've noticed, just like he mentioned, the smartest people that I've seen, especially from the world of ETFs, have been graduating over to the Bitcoin space. The sheer amount of brain power there is unbelievable. On that same broadcast on the Kevin Simpson Show, Guy Adami came on and he gave some really good advice. And this was recorded about a month ago. It still holds today. As a financial advisor, dealing with rising rates is a real challenge. Here are Guy's thoughts.
They have to ask themselves, I think we've been lulled into this sense that rates are never going meaningfully higher and that the Fed will do everything they can to hold rates down. And that's been the case now for the better part of a decade. But I think, again, we're on the precipice of something changing here. Dan and I were doing a podcast earlier today. We looked at the CRB index. I encourage your audience just to take a look at that chart over the last year, and I think you'll see exactly what I'm talking about. Inflation is here in spades, and at a certain point, the 10-year yield's going to catch up to where things are. So what does that mean for advisors? Well, again, you've been able to do this now for a reasonable period of time. I think the world is changing. I'm not suggesting the market's going to collapse or anything like that, but I do think some of the underlying components of the market are going to change in a meaningful way.
Another reoccurring theme that we've seen on the show is the challenge of dealing with 60-40 portfolios. And, Guy really speaks to it right there. Now, let's transition over to a couple of ETF stories. So Amplify ETFs have the cannabis ETF run by Tim Seymour, and he recently did a quarterly update, which he talked about some of the trends they're seeing state by state as it relates to cannabis legislation.
Let's talk about CNBS. First of all, this is an active ETF strategy which endeavors to give investors thematic but alpha generating exposure to the cannabis industry, which is a relatively nascent industry growing very fast with a lot of both regulatory and frankly bottom up evolving dynamics. This fund is intended to give investors exposure to those investments that make sense for this industry today as it exists now, and with an eye on tomorrow, where we think we're going to be, and the subsectors within cannabis that are as seemingly intricate and complex and as exciting as the big picture about cannabis, which is this, like, as I say, it's a generational investment opportunity. You have an industry that's growing anywhere from 40 to 60% a year. You have the end of prohibition. And at some point, we believe the size of this addressable market in the United States will be bigger than the entire alcohol industry. So I mean beer, wine, and spirits, but we'll talk about that.
You gotta love live broadcasting. I played the wrong clip, but that is the CNBS investment thesis. To learn more about the CNBS ETF, visit cnbsetf.com. I do want to play that clip, though, on Tim's thoughts around legalization.
You had new licenses being given out in Georgia, which is, as we might imagine, going to be a very exciting, important state. We had Virginia continue to evolve, again, a relatively new market for cannabis. GTI, very well positioned. I talked about where Trulieve and Harvest did this very, call this a groundbreaking M&A transaction. But meanwhile, Trulieve was already hard at work building out their presence in Pennsylvania, which is considered to be one of the most profitable markets.
All right. Again, to learn more about the CNBS ETF from Amplify ETFs, visit cnbsetf.com. All right. So next, I want to play a clip, and then we're going to talk through it. I'm going to pull up a chart. 1-year returns for both of those. When you look at them from a risk on, risk off, what are they telling you?
So keep in mind, it's a little bit tricky with silver to gold as a ratio, right? So generally, the idea is that when silver is outperforming gold, because silver, which is often called poor man's gold, is performing, that would suggest that industrial activity is picking up, right? Because silver is used more in industrial applications than gold is. Mm-hmm. So silver's largely kind of gone round trip, right, as underperformed quite badly gold. But again, these things go through cycles. So on the one hand, you'd say to yourself, well, silver to gold actually would suggest that there's going to be a slowdown and some of this disinflationary fear might come back. Or, again, we may have already passed that. The ratio itself could start to turn up, and then that would also be confirming a sort of an offensive environment. But it's not clear. Again, silver to gold is worth noting as a relationship, but it's not something that's as clean of a risk on, risk off tell as things like lumber to gold, as things like utilities against the market, as things like long duration treasuries against intermediate.
That was Michael Guyette of Toroso Investments. He does a regular monthly show on Resilient Advisor. It's one of our more popular broadcasts because he talks about the markets through his risk on, risk off lens. His consistency is amazing. As we're broadcasting this, gold is broken out. It's starting to hit 6-month highs. Really worth paying attention to that gold silver ratio. If you like Michael Guyette's work, please go sign up for the Lead Lag Report. It's one of the best letters in the business. All right, so I want to play a clip from Chris Versace talking about the sectors to watch inside of the framework of their Detox ETF, which is the Cleaner Living ETF from Amplify. When you look at the fourth quarter and your current portfolio holdings, are there a couple of names that stand out to you?
Well, to be blunt, we reconstituted the portfolio back in June, and we'll do it again in December, which will take place into 2022. So there isn't a lot that we'll be getting back into the portfolio, but I do think that as global supply chains ease, right, as perhaps we get some abatement of raw material input prices, there will be other sectors that start to benefit. We've also got, the seasonal trade, if you will, in food, for example. We know that, given the holidays, whether it's Thanksgiving, Christmas, New Year's, that they tend to be a big food-centric holiday. We also know, too, that, around the globe, the service economy is continuing to improve. It's also doing so in China. So we're possibly seeing a rebound in that after the Delta variant. And again, we're going to continue to see more economies around the world opening. So I think by and large, the drivers for the vast majority of the portfolio will be very positive. I do think what we've seen in oil prices as we speak, Jay, over $82 a barrel, that is going to be a natural catalyst, not only for EVs, but also for alternative forms of energy, whether that's solar, whether that's wind, hydro, what have you. So, going into the fourth quarter or deeper into the fourth quarter, do we feel positive about the portfolio and the prospects for it, both near and longer term, given the forecast figures that I shared earlier? Absolutely.
Interesting, playing with new technology in a live broadcast. We're going to see if this actually goes off the screen, given where I'm pulling these videos from. I appreciate everybody playing along with us here. That was Chris Versace talking about what he saw in the Amplify ETF's Detox Cleaner Living ETF. And if you're not familiar with that ETF, it launched earlier this year. It's an interesting take on, in my opinion, almost a different lens on ESG potentially. Learn more about that ETF by visiting amplifyetfs.com/DTOX. Next, I want to play a video from Christian Magoon, who's actually the CEO of Amplify ETFs, and they recently launched a new ETF called BIDS. Here's the investment thesis. Today, I'm speaking with Christian Magoon, CEO of Amplify ETFs. Christian, since this is a new ETF, let's start with the investment thesis.
Yeah, Jay, it's really interesting when you look at life across the board, whether it's retail, whether it's some of the different types of technologies that are happening now. We're seeing a digitization of everything, and that includes trading securities, stocks, bonds, commodities, digital assets, NFTs, and that's really why we launched the BIDS product. This is the first ETF to access a group of companies that are behind online and digital trading of all types of assets. So this includes e-brokers, digital asset trading platforms, market makers, the whole gamut. One way for you to get exposure to this area that really isn't found in the traditional financial ETFs and represents what we think a great growth opportunity going forward.
All right, so learn more about the new BIDS ETF by visiting bidsetf.com. That is bidsetf.com. Next, I want to play a clip from Michael Venuto talking about the Block ETF.
I'm real excited about how some of these miners are doing unique things and changing the landscape. So, for example, Hive, Frank Holmes's company. One of the things we like about that is it's a diversification for us. He's one of the largest Ethereum miners out there, so it's not just Bitcoin exposure that we're getting. Hut 8, another one of our larger mining positions. I got to meet with management at the SALT conference earlier this year. I actually got to see many of our CEOs there, Novogratz and Steve Ehrlich from Voyager and Jamie from Hut 8. And it was just great to see how they're embracing the capital markets and traditional finance to literally finance building out different types of mining and utilizing things in that space. So there's a lot of exciting things going on, but obviously right now the mining space is the most interesting.
To learn more about the Block ETF, visit blocketf.com. That's blocetf.com. And if you are interested in learning more about cryptocurrency and the blockchain space, Michael Venuto and his team do a really good job educating. Dan Weisskopf, one of his partners, produces the blockchain interviews, which you can find by visiting theblockchaininterviews.com. He's had guests such as Michael Saylors, who we actually live streamed that episode here last month. And they just do a really good job of educating about the blockchain space before you go out and make investment decisions. As you well know, it's really important to make sure you understand the marketplace. They're big advocates for the space. All right, before we wrap up the investment side of this live test broadcast, I want to play a clip from Kevin Simpson talking about Devo.
The strategy for those of you who are new to the Amplify CWP Enhanced Dividend Income Portfolio, and that's a mouthful, huh? Devo. We're a portfolio that it revolves around large cap, high quality blue chip stocks. Everything in there is being selected for quality, but it's also being selected for dividends. And it's not a high dividend strategy. It's a dividend growth portfolio. We're looking for companies that have a long-standing history of increasing dividends over time for the right reasons, Jay. We want companies that are increasing those dividends because they're increasing earnings. We also add a tactical covered call component to it, where we're generally looking to harvest volatility, buffer a little bit of the downside. So you've got a great exchange traded fund.
So the Devo ETF is a covered call strategy that also focuses on dividend growth stocks in the underlying basket. So that ETF over the past 2 years has grown from 25 million to about 750, 800 million. It's a great story that's been delivering, 5-star rated by Morningstar. To learn more, visit devoetf.com. And to learn more about capital wealth planning, visit capitalwealthplanning.com and make sure that you follow the Kevin Simpson Show. So let's pivot now from investments to talking about some of the practice management concepts that we've seen on the show here recently. Here is a clip from Ross Marino's show, Shaping Change, where he interviewed Taylor Schulte on helping advisors find their focus.
To anybody, the first thing is to actually document your niche and get as clear as possible. I love this idea of creating this avatar and giving that avatar a name and a profession and an age and an income and how many kids do they have? Are they married? All this stuff, like draw and create this avatar of your perfect client. And that's often the hardest part. And then from there, it was identifying, okay, if that's our avatar, who in our practice that we're working with right now, who doesn't fit that avatar. And that's the hard part. It's easy to create that list of who doesn't fit, but the hard part is now having conversations with those clients and then transitioning those clients out. Not only are you having hard conversations with these people, some of which were my mom, my grandfather, my mother-in-law's best friend. These are hard conversations to have. But like you said, I've got a family to feed. I need income. I'm also losing income as part of this process as well. So I committed to this process knowing it was going to take a couple of years to kind of get back to even again. And one by one, I had those hard conversations with each person. It was the typical, it's not you, it's me, in order to kind of better serve my clients. I'm, getting really specific. I've often used the doctor analogy. You wouldn't go to a neurosurgeon if you needed knee surgery, or you wouldn't go to a divorce attorney if you had a personal injury case, right? And so in an effort to better serve my clients, we're getting more specific. And I just don't think I have the right expertise to help you. And so what I did is I offered for each one of those clients to help find them a more appropriate advisor based on their situation. And one by one, we made that transition. And it was difficult, but that's the process that I went through.
So Ross Marino also had the chance this fall to sit down with Daniel Crosby, the Chief Behavioral Officer over at Orion. And they had a really wide-ranging conversation, but here are the 5 most common money and narratives that Daniel speaks about.
When people fight about money, the 5 things they fight about are, first, communication, right? So some people have been taught that money should be discussed openly and honestly. Others have been taught it's whatever, sex and religion and politics, you just don't talk about it. The second thing is worry, apprehension, right? Are you a big worrier about money or no? The third thing that people disagreed about was the function of money. This was actually the source of the biggest disagreement. was money used to secure tomorrow or to enjoy today? Right? Was it you to, are you going to seize the day with this money you have, or are you going to secure your future self? And then the fourth thing was orientation, right? Like, is this my money, or is this money to sort of bless the lives of my community and my family and my church and my government, or whatever? Or is this like mine? And then the last piece was importance, right? Is it important for you to be, sort of outward displays, outward trappings of wealth, like to drive a nice car, to have a nice house, things like this. And so all of them are like this, but I'll draw your attention to the one that the most people fight about, which is function, right? So like, what's the right answer for the function of money? Is it used to enjoy the day or secure tomorrow? Well, the answer is both, right? Like the answer is both, but in moderation. And so, one of the things that we're trying to do is help people better articulate these money stories and find a balance, right? Because again, going back to the orientation, you need enough, you got to put your own sort of mask on first. You have to make sure your financial future is secure. But then once you've secured your financial future, help your church, help your community, help your kids, help your family. And so, yeah, we've got to ask questions like the kind that you ask in your process to elicit these money stories and help clients articulate them, call them out, and find balance with them.
I tell you, Ross Marino does a great job bringing on high quality guests to Shaping Change and his Outcome Show. Dr. Crosby, I could listen to him forever talk about the human side of the advisor experience and the client experience. So I want to play a clip from an episode that I did of How I Serve about 6 months ago with Desarty Yanwe. And the reason this clip I think still holds today is because he explains why he uses the Altruist platform for his business. If you're not familiar with Altruist, they are a cutting edge broker dealer for RIAs that want to serve their clients with a really crisp, clean user interface and great service model. So here's Desarty talking about why he uses Altruist. To wrap up with a discussion about Altruist. And so here's my disclaimer. I have a custodial relationship with Altruist. I think they're fantastic. I've got my own accounts over there. I've loved watching what Jason and the team have done to have the platform evolve. You have a role at the firm. I'd like to hear about that, and then why you think Altruist is the right custodian for you and your firm.
Yeah. I am the head of community at Altruist. Altruist has a mission to make financial advisor cheaper and more accessible for everybody. So if you think about the journey that I just outlined in this conversation, I was seeking to solve that same question prior to leaving the bank. Why can't I work with my mom? Why does she have to have $2 million in liquid assets for me to onboard her, right? So when you think about Altruist, we want to make this more accessible. My role is to market to advisors through our podcast, the Human Advisor podcast, through our growth series, and give them all the tools that they need to scale their business effectively, whether or not they're with Altruist, right? I think Jason Wank and team are geniuses. I think Jason has been trying to really improve the financial services space since he got into the business over 20 years ago. And I think Altruist has a fantastic product, a fantastic user experience, but a very, very, very bright future ahead. So I'm super bullish about everything that's going on at the company right now.
Yes, I'm bullish on Jason and Altruist as well. Sorry for the delay setting up that video. That's part of the growing pains on learning how to do this live broadcast with clips. Next up, Chris Davis has been a staple in the investment industry for decades. His family for 60, 70 decades. They were recently on an ETF think tank exchange, and Chris gave his thoughts on what's needed to build a great company culture. Want to share those with you.
If you think First, rather than think about our firm, if you think about the sort of businesses that we want to invest in. So when we're doing research as analysts, as portfolio managers, we're studying businesses, we're thinking about buying and owning that business in perpetuity. So we're looking and calculating the value of that business as if we bought the whole thing, and the earnings and cash that it generates becomes our return. In the same way, if you bought a piece of commercial real estate for $100 million and it was generating, $8 million a year of profits, you'd think of an 8% return if that grew to 12 million, 15, and so on. So when we think about that long-term time horizon as investors, we think a lot about culture, because as investors in public equities, we're delegating to management the decisions about reinvesting capital. And so we're looking for people that have a partnership mindset with their shareholders. And if they start taking short-term routes, that will end up hurting shortcuts, that will end up hurting us in the long term. So similarly with our firm, we have this mindset of if we want to build generational wealth, how do we build a culture that has that orientation? And just like with public companies that we invest in, we start with incentives, right? We want to be owner operators. We want to invest in owner operators. We want to be owner operators. And that doesn't mean owning the management company. It means investing in the funds alongside our clients. And that is, I think, the most important difference in our mindset. If we have, over $2 billion, our family, our employees invested alongside our clients in the funds, it means we do a lot better from 10% better performance than 10% more assets under management.
Chris Davis is a legend. His company has been so consistent over the years. Great to hear him in that clip talk about the importance of company culture. Earlier this year on my ETF Stories series, I was able to interview the team from Evoke that are the portfolio managers behind the RPAR risk parity ETF. Well, they were actually on the ETF think tank as well last month. And on their visit, they talked about the challenges with the 60/40 portfolio. I want to play you a clip of Alex Shahidi talking about that construct.
The conversations that I'm having, I think advisors and their clients are thinking about restructuring the entire framework of their portfolios. Because if you think historically, 60/40 worked fine because stocks and bonds were, zero correlated or negatively correlated at periods, and yields were falling. So you had this tailwind supporting both the stock and bond markets. Now looking forward, you have, near zero yields in bonds. Equities are relatively expensive, and inflation is the biggest concern looking forward. So all of those are bad for a 60/40 portfolio. So if you think about what the future, let's say 5 to 10 years looks like, it's a big guess as to if we're going to have high inflation. We could even have deflation if we end up like Japan. All this money printing and zero interest rates, what does it mean? All the political concerns, the debt ceiling talk, there's just so many big forces at play. So the potential outcomes in the future could be wide ranging, and the odds of an extreme outcome is greater. And so being really well diversified is probably the most important thing. That's probably the biggest message I would share today. And 60/40 isn't really that well diversified. It's equity dominated. You have 60% in a volatile asset, 40% in a low volatile asset. And so that portfolio as a whole is going to be over 90% correlated to what the stock market does. You basically have all your eggs in one basket without realizing it. And I think people are starting to become aware of that. And so we think of it in the risk parity framework, where effectively you own assets that do well in different environments. So you protect yourself against all those outcomes, and then you risk balance them so that for the most part, you're indifferent to what the future looks like. And that means owning assets like equities, even treasuries, even with their low yields, because if you get a downturn, it's likely to appreciate.
Yes, the 60/40 portfolio is presenting problems for financial advisors. We probably have 2 folks a month that come on talking about the challenges that brings for financial advisors. Let's shift to Bitcoin. Dan Weiskopf of Taroso Asset Management and the ETF think tank produces a series called The Blockchain Interviews. I mentioned it earlier. He has some of the brightest minds from the cryptocurrency space on. I want to play you a clip from one of his interviews with Mike Cagney, and I thought that this topic was incredible.
Figure runs marketplaces on Provenance, but we don't own Provenance, and anyone can build a T-Instant marketplace on Provenance, but all our trades are T-Instant. And so so the equity that was sold, and I did a jab at DTC and ICE and NASDAQ on the last transaction and said, hey, we just traded private company stock at T-Instant settle, right? Why are you still on T+2? And the DTC has this view that blockchain won't work because you need to pre-fund every transaction, and you do have to pre-fund every transaction to eliminate counterparty and settlement risk, right? That's how the two sides face off, and you can effectively encumber the fiat and the asset and eliminate the settlement risk. But they operate under a false dichotomy because they're assuming that money's coming in through Fedwire, not through stablecoin, because stablecoin nets indefinitely, right? And so once you introduce stablecoin into the equation, you get real-time netting versus end-of-day netting, which is what DTC does, and you effectively create a T-Instant settlement system. DTC has got $50 billion of street capital it holds for settlement risk right now. All that goes back to the street. It charges a bunch of money for what it does. All that goes back to the street. But what's profound about this, and I think what people don't truly appreciate, especially in the exchange construct, is, blockchain exchanges, because they're bilateral, it's just you attaching your wallet to a decentralized exchange. There is no introducing broker, right? And so not only do you disintermediate NASDAQ, ICE, DTC, you disintermediate Schwab and Robinhood and Fidelity. Like, you don't need a broker anymore.
Dan Weisskopf really brings on some of the best guests in the space. So one aspect of the cryptocurrency space is mining. I find it fascinating. Frankly, I don't even fully understand it, but I do see how those companies are progressing. Dan had an opportunity to ask Frank Holmes exactly how big he thought that the mining space could be. And I want to play you that clip.
Looking at $100 billion, a $200 billion industry in years out?
Oh, I think so. I also think that it's also related to cheap capital. I've seen this rodeo in the gold mining industry. The gold royalty companies love it when there's no funding available, so therefore they get to pick their best deals. And as soon as the capital markets heat up and there's cheap money around, they can't carve out great deals. And so right now there's an abundance of cheap money, and hopefully some of these other players are out there are actually going to be able to deploy what they promised to be able to deploy. We said we would have an exahash by August. We delivered. If you convert it, it's interesting. Hive was the first public company in the space, and the Riot then came and jumped on the bandwagon. But they were all about pumping up stock, and they all got spanked, which is good. But most of the other guys jumped in this business were really stock promoters. It's a flavor of the month, and they're all gone. This has real great CEOs. The caliber of the CEOs is another level, which I can relate to so easily. And I know that when I have to go and speak at conferences, etc., I have to have my A game. I have to, like, I'm walking on the court with true NBA type players. So the industry is evolving nicely. How different people will pivot. Once we get a real bear drought, there's no source of capital, cheap capital for people to buy all this equipment they're doing, then I think you'll see mergers and acquisitions take place. But right now it's can I get more capital on my balance sheet? And the market has rewarded not revenue and cash flow like we've delivered, more so it's on all this expected future revenue and cash flow.
Clearly, I'm going to need to get quicker at switching in between these clips. The last clip that I want to play you from the blockchain interview series with Dan Weisskopf is from Nick Carter. Nick Carter came on for a wide-ranging interview. They talked about some really great topics in the blockchain space in depth, but Dan asked him about venturing beyond Bitcoin. And here's what Nick had to say.
Years, I was just only exclusively interested in Bitcoin because Bitcoin needed a lot of help. I mean, it's still a project that's sort of in progress. And now it's kind of reaching a state of maturity where, I think it is stable and, somewhat mature and has exit velocity. And I think Bitcoin's going to be fine, sort of regardless of what happens. And the future of Bitcoin isn't that uncertain to me. I think there's a definite pathway for what's going to happen here. As we grew our fund and expanded our focus, we started investing in startups that were building on other blockchains, just out of pragmatism, not out of, some ideological desire to pursue one blockchain over the other, just out of, well, there's certain things that I need to do as a startup that I can't necessarily do on this or that blockchain. And so through that, we gained, I think, a bit more of a pragmatic attitude towards, the the inherent conflict between blockchains. And so I don't consider myself a maximalist. Frankly, I think the term is a little sort of semantically diffuse. I'm not exactly sure what it means, but I'm definitely a Bitcoiner, but that's not to the exclusion of, at the very least, financing startups that are building elsewhere. And there's a number of other blockchains that our startups are built on. I mean, I co-founded a data company, Coinmetrics, and they run nodes for something like 50 or 60 different blockchains. And so I understand the view from the Bitcoiner camp that, promoting alternatives to Bitcoin without disclosing the sort of inherent trade-offs those alternatives are making, that's maybe morally questionable. But in terms of there being other objects of interest in the industry, I'm pretty open-minded about that.
If you're new to Bitcoin and blockchain, check out the blockchain interviews. I would actually start with that Nick Carter interview. It's easy to go to some of the higher profile shows like Michael Saylor, but Nick does a great job in a very methodical way of laying out the real value proposition for having an allocation to the space. Susan Bradley is the founder and CEO of the Sun Money Institute, and she is all over media with her great thought leadership around dealing with the human side of working with clients. And I want to play a couple of clips from some episodes that she had with Ross Marino on working with clients through retirement. So the first, she shares her thoughts on what you need to protect while you're in retirement. Well, that did not launch. Let me try it again. Here's Susan Bradley on what you need to protect in retirement.
Do I want to protect? Which makes the assumption that everything didn't change. Maybe a lot of things changed, but there's some things that don't have to change. And we go through this exercise of saying, this is what I need to protect. Can you talk about how we do that and why that's so important?
Yeah, it's interesting. What happens when you go through these major life events? We can compare it to maybe even a jigsaw puzzle. The puzzle that would represent your life gets disrupted. Maybe all the pieces come apart, maybe some of the pieces come apart, but there is a disruption. And your job then would be, or your opportunity is to put the pieces back together the way you would like life to be ongoing. And while you're doing that, some things may feel at risk. When you have broken your status quo and your routines, some things can feel at risk. It could be your health. It could be your money. It could be a relationship with someone.
Well, we lost the audio on that clip. Again, experiments in advisor broadcasting. I want to play another clip from Susan where she helps advisors understand how to guide clients in retirement and specifically around what they need to let go of as they are hitting their retirement years.
What do you have to let go of? And leading up to retirement, I may have an idea of what I might want to let go of, but after retirement, now all of a sudden I'm going to see things a little bit differently. How do I approach question number 2? What do I need to let go of?
Yeah, it's a really important question. It helps to clarify things, doesn't it? Because if you go back to the puzzle metaphor, there are some pieces that don't fit as well as they used to, or some pieces that don't fit at all. And rather than trying to force a piece into a jigsaw puzzle, I think we've all had the frustration of trying to do that at one point in our life. It really doesn't work. The end result is not effective. So you might feel that things are no longer fitting. Maybe they're not comfortable. Maybe you don't want to do them. Maybe you can't do them. Maybe you, because of some change in the way your brain works or the way your body works or the way other commitments are, there's some reason that these things don't fit. And it doesn't make a lot of sense to try and keep making them fit. You can try some adjustments, but there's a real freedom in letting go and letting some things go. It doesn't mean that you can't do them. You might just choose not to do them, but create some space, create some room for something else to happen. And don't try to hold on to everything that you had before or you think you should have now that you're retired.
To learn more about the Sudden Money Institute, visit suddenmoneyinstitute.com and make sure you follow Susan on Twitter. She's at Sudden Money, and Ross Marino, who's Ross 2_Marino. All right, I'm about to play our final clip, which is actually, in my opinion, the most important clip. But because this is a test, a new broadcast, we've had lots of things go wrong. I've had trouble getting videos launched. We've had sound go out. My monitor's gone out behind me here. I'd love to know if anybody is still watching here at the end. So if you're watching here at the end of our first Friday Rewind, send me a message, send a screenshot of my face right here with Friday Rewind on there, and we'll send you a copy of my book, The Resilient Advisor. All right, so I want to wrap up with the most important topic, and I don't even hedge myself to be correct on this, to be politically correct on this. Inflation is destroying lives. If you have money, you've barely felt it. If you are in the middle class, even upper middle class, it is coming at you fast. The only way people can protect themselves during periods of high inflation is to get great financial advice, and financial advisors are in the best spot to do it. One of our passions is helping advisors make sure that advisors do not fail retirement, and inflation is the number one way folks will end up failing retirement. I want to play you a clip of Michael Guyad and Lenore Hawkins talking about how they think you should look at inflation.
I can make a case to you that given the way inflation expectations have been behaving, that yield should be a hell of a lot higher unless inflation expectations are wrong, which is just sort of a side note. We have this kind of interesting tug of war between absolute yields and inflation break-evens within the bond market itself.
Given that construct, A, what are your thoughts? And B, how should financial advisors think that through as they're managing portfolios here at the end of the year?
Yeah, I think he's dead on. So we've got all of this inflation data that looks on face value, it doesn't look so good, right? We keep seeing inflation going up, prices going up. But if you look at the bond market, and the bond market has a long track record of being pretty good on this stuff. You know, the bond market is a smart one. The equity market is the one that's kind of gets a little overexcited and then overly depressed. And the bond market's a little bit more stable. The bond market, we're not seeing these things reflected. In fact, if we look at, here we go, yeah, look at this 10-year yield. I mean, how is it that we're supposed to be having this really dangerous high inflation when the 10-year yield peaked, the most recent peak, it peaked in November of 2018 at more than 3.2%. And today it's under 1.6, so it's less than half of that. So 3 years ago, it was twice the rate it is today. And 3 years ago, no one was talking about this terrifying inflation. And it isn't really just the treasuries that are remaining low. If we look at both the investment grade and the high yield rates, those are also staying really, really low compared to what we've seen in the past, back when we weren't talking about a crazy inflation. So the bond market, it's not really buying this whole inflation story.
I appreciate you tuning in to our trial broadcast of the Friday Rewind. Clearly, we have a lot of kinks to work out, but boy, that was a lot of really, really good content and actionable ideas for financial advisors. To learn more about the launch of Financial Advisor Television, please head over to financialadvisor.tv. That is financialadvisor.tv. And thanks for tuning in.